Hey guys, what's going on? It's Lewis here with Crypto Elite, and this is part 2 of the How to Trade and Invest into Bitcoin and Cryptocurrencies series. In part 1, we talked about what makes a market, what investing and trading is, and what different investment styles you could use. We also talked about trading and what the difference is between trading and investing. We talked about how you could become a successful trader by finding what's known as your edge. And we went over different trading styles that you could use. Now that you understand these things, you should have a great understanding of the basic concepts behind investing and trading. Now it's time to dive a little bit deeper and talk about how you could actually invest and trade intelligently. We're going to be going over the different technical aspects of trading and investing, including analysis that you could use when determining when you're going to buy and sell. We're also going to go over candlesticks, charts, and other things that you should know about when you're trading and investing. For you, the most important thing to do is to smash that like button and leave a comment, especially if this video was helpful. That takes 2 seconds and it really helps the channel out. All joking aside, this video does provide a lot of value for you, especially if you're new to trading and investing. I hope you enjoy it, learn a lot from it. You probably want to take notes on a pen and paper or a notepad because there is a lot of information. It will cover technical and analytical things about trading and investing, and it might be a lot to cover. And then the last thing that I want to say before actually getting back to the presentation is, yes, I'm wearing my Crypto Rays. These are blue blocking glasses for traders, investors, entrepreneurs, and I would love it if you can go over to getcryptorays.com and check them out. I made these glasses after I transitioned from the health field into the cryptocurrency field because I went from doing yoga on the beach to sitting in front of my computer all day, every day, and I needed to protect my eyes. So I created these glasses. I love them, and that would mean the world if you could check them out as well. And with that out of the way, let's just get to the disclaimer and then do the actual presentation. So I'll see you in the presentation. We're going to start with fundamental analysis and then go from there. So I'll see you there. We're going to start off with an example of fundamental analysis. Basically, it's like this. If you heard of Bitcoin back in, say, 2010, would you have invested into it? If you did invest, it would have been purely based off of fundamental analysis. Fundamental analysis is the analysis of the fundamental aspects behind an asset. Fundamentally speaking, Bitcoin introduced a brand new technology into the world that solved a major problem. Fundamentally, it brings massive value and an entirely new feature or function to the financial industry and the world as a whole. Bitcoin has a huge user base and developers that are actively working on it. All of these things make Bitcoin a fundamentally sound crypto. Different fundamental attributes in regard to cryptocurrencies include what the purpose of the coin is, what problem is it trying to solve in the real world, is there any meaningful way the coin can be used? Is there proprietary technology in the company? Is there a product that's available? How easy is it to use? If there is a product, are people even using it? Who are the actual team members behind the crypto that are building it? That one's very important. What are their backgrounds like? Do you think that they have what it takes to accomplish what they set out to do? How long has the crypto been around? What is the capital position of the company creating the cryptocurrency? What is the white paper like? What does the roadmap look like? What are the milestones they're trying to accomplish? Have they accomplished previous milestones? Does the cryptocurrency have an active user base? Is there growing adoption? Does it bring anything new to the market? And finally, does the coin have enough volume to be able to trade it? Or is it something that you'll have to just simply buy and just wait because there's not enough liquidity? You know, these are all things that you should consider before investing into a cryptocurrency. If you like what the coin has to offer on a fundamental level, you could then look for competitors and then compare them. Fundamentally analyzing cryptocurrencies to make sure that they are solid projects is always a smart move. They say that you can get rich by technical analysis, but you could get wealthy by using fundamental analysis. I think there is some truth in that statement. Many times there is news about a cryptocurrency that can drastically drive up the price. For instance, if there is a partnership or an upgrade to the network taking place, the crypto's price will usually rise up until the announcement itself. Usually the price will begin to rise, the announcement will come out, and it'll say that, say in a month or two, something special will happen. Then the price will rise up until a week or so before the date of the event, and then the price will dump. This is actually a real trading strategy that you could use. It's called buy the rumor, sell the news, and it tends to work really, really well in crypto. And while fundamental analysis is always a good idea, you should always check the charts and use what's known as technical analysis before you buy or sell a crypto. That is incredibly important. You should always check the charts and understand at least the basics of technical analysis. And that is why we're going to go into technical analysis right now. So, technical analysis. Technical analysis is often simply called TA. It's the analysis of the price on a chart or a graph. TA uses the previous action of the price along with many different indicators to help the trader or the investor formulate a strategy and determine where they will buy and sell their coins. If you want to become a trader, you will use technical analysis. Now, there's two types of technical analysis. There's price action, which is the classical technical analysis, and then there is computerized technical analysis. So let's go over the price action or the classical technical analysis. So price action TA is when you gather all of the information from the past movement of the price and you look for shapes and formations in the price action. You then use that to come up with hypotheses on where you think the price will go. Understanding the different shapes of the candlesticks and memorizing the different shapes and formations in the chart, it's one of the first things that you should do when learning how to chart. Every candle tells a story. You should learn what the candlesticks are telling you. Here's a picture with some information about candlesticks and a picture of a random chart. As candlesticks continue to be printed out on the chart, they form different shapes and formations. These include support and resistance levels, flags, pennants, wedges, triangles, which are ascending triangles, descending triangles, symmetrical triangles, there's bottoms and tops, there's head and shoulder patterns, there's the cup and handle pattern, and there's so many other patterns that it would take forever to go over them, but here is a picture of the different patterns that are commonly formed in the charts. And like I mentioned before, if you want to trade, candlestick formations and chart patterns should be some of the first things that you dedicate yourself to learning. Now, in the Crypto Mastery course by Crypto Elite, I actually go over candlesticks and formations and patterns and all of these things in really, really great detail to teach you exactly how to read candlesticks and read the charts. If you're interested in that, then you could find it at cryptoelite.com and you could sign up for the course there and learn how to read the charts. So what we just covered was price action and classical technical analysis. The other type of technical analysis that I said was computerized technical analysis. So along with these chart patterns that you could visually, see and create, there are actually computerized indicators that can help aid in your analysis. There's way too many indicators to count, but the main ones are the moving averages. So these are the just moving averages, the simple moving averages. There's the exponential moving averages. And then there are other things like the MACD, the relative strength index, or the RSI, stochastics, different oscillators, and so many more indicators. Now, I actually, like I mentioned, not only go into the price action strategies, but I also cover all of these indicators in the Crypto Elite Mastery course at cryptoelite.com, and I'll put a link in the description if you're interested in learning about all of these things in detail. And of course, I'll have more videos on YouTube for you as well. So now that you know about candlesticks, chart patterns, and different indicators, you need to know where to go so that you could see the charts, plot the patterns and indicators, and determine where you want to get in and out of your trades. So now we're going to talk about trading charts. The place you want to go to chart is called tradingview.com. This website allows you to chart almost any coin that you want. Now, I will have a very in-depth video on TradingView and how to literally go over everything within TradingView. So definitely subscribe if you don't want to miss the TradingView video when I release it. So on the screen now is a chart on TradingView of Bitcoin. This is just a regular chart, nothing is on it. Now we're going to put on a chart with chart patterns drawn on it to show you how traders use them to determine where to buy and where to sell. On the left, you'll see a neutral triangle. On the right, you'll see an ascending triangle. In the middle, you'll see an inverse head and shoulders pattern. What you'll notice about the triangle chart patterns is that they start out wide and the ends get closer and closer together. This happens because the price starts consolidating. When prices consolidate, they form what's known as equilibrium patterns. The price makes either lower highs, higher lows, or both. You could see on the triangle on the left that the price continued to make lower highs. You could see on the ascending triangle on the right that the price continued to make higher lows, yet the highs remained the same. This is typically bullish, and a price break to the upside with nice volume and a close above the resistance is a confirmation that the pattern worked. In this example of the ascending triangle on the right, it would make sense to long or buy as soon as the price broke through and closed above the resistance, and have a stop loss that will close your trade out if the price comes back down below the resistance. That way, in case the break was a fake out, you won't lose too much if the price reverses unexpectedly. As the price gets into a tighter and tighter range, it's sort of like a tightening rubber band. Eventually, it will break in one direction or the other. You never know what direction it'll break, but you could use the probabilities that certain patterns break up while other patterns break down to guide your bias. Like I mentioned, the ascending triangle pattern is a bullish pattern, and that means that more often than not, the price will break up through the resistance. Knowing this, I'm more prone to long or buy an ascending triangle pattern compared to, say, a bearish pattern. So knowing what patterns are bullish and knowing what patterns are bearish and knowing why they are bullish and bearish is really important, and that helps with your risk tolerance while trading. So the safest way to trade is to trade the confirmed breakouts of patterns. Another great way to trade is to play the support and resistance levels. Sometimes it could literally be as easy as buying at the support and selling at the resistance. In fact, just doing that alone can be super profitable. How you choose to play patterns is up to your personal preference and risk tolerance. The greater the risk, the greater the reward. This is always the case. And so you could see that there's the three different examples of the classical chart patterns. There's the neutral triangle, there's the inverse head and shoulders, and then there's the ascending triangle on the right. And these are classical, price action chart patterns. Remember though, there's also computerized technical indicators that can really help out with your trading. So knowing that there's computerized technical indicators, let's bring some up on the screen. So here's that same graph with two indicators, the MACD and the RSI. I've drawn some lines in yellow that were big indications telling what the price was going to do. The lines that I drew are called divergences. A divergence happens when the price moves up, but the indicator moves down, or vice versa. You could see on the first yellow line that the price had two peaks, with the second peak being higher than the first. However, looking at the RSI, you could see that the second peak of the RSI is lower than the first. This shows that the momentum is weakening and is a very strong sell signal. The second yellow line shows the opposite. The second low point in the price is lower than the first. However, the second low on the MACD indicator is higher than the first. This shows an increase in the momentum and that a move up is very likely to happen. Playing these divergences on the RSI and the MACD can be one of the best strategies in trading. Their success rate is incredible. Divergences are actually so powerful that even when they don't work, that is actually an indicator telling you that something fundamental is probably happening behind the scenes, and that actually turns out to be a signal in and of itself. Learning indicators like the MACD and RSI can add even more confluence to your trades. Having too many indicators, however, can convolute your charts and confuse things. You should always start with the price action and then use indicators to confirm your intuition. And you don't want to have, 20 different indicators up, because if you do that, then a lot of them will give you one signal and a lot of them will give you another signal, and then things could get really confusing. So my suggestion is to just stick to a few, 2, 3, 4, 5 at the most. However many you do decide to use, indicators can be used as incredible tools to help you trade. Now, along with technical analysis and indicators and fundamental analysis, one other tool you could use is actually called the order book and the trade history. So let's put that up on the screen right now. The order book on the left side shows all of the orders that have been put into the books but haven't actually been executed yet. The trade history are the ones that have actually already gone through and been executed. This lets you see the buy or the sell pressure and can come in handy when making quick trades. So if you see huge buy orders coming through in the trade history, you know that the buyers are in control. The order book is on the left side, and that tells you the orders that have yet to be placed. This is where you could see the amount that the bidders and the askers are putting into the books. The trade history is on the right side, and that tells you the actual orders that went through. A lot of times bots will spam the order books, or whales will manipulate the order books by putting in huge fake wall orders and then pulling them at the last minute when the price reaches that level. These whales can confine a price within a certain level by consistently buying and selling and putting up a huge buy wall and huge sell wall. Because of this, the order book always needs to be taken with a grain of salt. If you see a huge order in the order book, you want to make sure that your order is filled before it. So place your order before the huge orders to ensure that yours gets filled. On this one, there's a 19.7 Bitcoin order at $9,936.54. So you would place your buy at $9,936.55 or higher to ensure that you get filled. Otherwise, that 19.7 Bitcoin will have to fill first. As a side note, always put your orders at odd numbers above round numbers. So instead of placing your order at, say, $10,000, place it at $10,011. Instead of selling at, say, $13,000, sell at $12,983. It just helps to ensure that you get filled, and it helps to ensure that you actually sell and your profits get taken. So the order book tells you what trades are in the system but haven't been executed yet, and the trade history are trades that have actually gone through. So if you're seeing huge buys go through, that could be a good indication as to what direction the market is actually moving in. Green orders appear when the asks are filled. Red orders appear when the bids are filled. You should look at the size of the orders, and that's important. Do not just pay attention to the color, because bots can spam this and make it appear all green or all red with incredibly small orders. So when looking at the order book and when looking at the trade history, more importantly, pay attention to the sizes of the orders. The bigger numbers show what direction the momentum is going. A strategy you could use is to actually look at the order book and to see if a huge sell wall is getting eaten up by the buyers. And if you want to buy, you can wait until the majority of that sell wall gets bought up, and then you can market buy to quickly get in before the price shoots up. So for example, if you see a 40 Bitcoin sell wall go down to 30 and then down to 20, and then you see a huge buy for 15 Bitcoin go through, that would leave only 5 Bitcoin left out of that sell wall that was originally 40 Bitcoins. If there's no more sell walls, you can make your purchase right there, and the momentum will be on your side for the price to move up. This is a totally viable strategy, but for most trades, it's usually better to plan everything out beforehand and have your orders set as what's known as limit orders. The same thing can be said for the bid. So if there is a huge buy wall and it just continues to get chipped away at, and the price is not moving, then eventually when that giant buy wall gets taken out, a flood of sells will cascade over the asset and lower the price. Obviously, in a situation like that, you would want to sell. And that is the order book and the trade history. One other thing that you should really be aware of is the market sentiment. So I'm gonna put up a couple pictures on the screen right now. So sometimes the sentiment of the market can be so strong that indicators can say one thing, but the price will do the exact opposite. For example, if the sentiment is extremely bullish, you may have indicators like the RSI and so many other things that say that the price is overbought and it's too high and it needs to come down. Like, it just has to come down because that's what the indicator is saying. But if the sentiment is strong enough, and the sentiment is so strong, and the fundamentals and the general market is so bullish, indicators like that won't mean anything. The price will continue to go up regardless. That means that if you use indicators, you need to, 1, understand what they mean and how to use them. And then 2, you need to understand when the correct time to use them is and know when not to use them, which is even more important. And this is something that I aim to teach in the VIP member area and in the Crypto Elite Mastery course that I've mentioned before. So if you want access to the VIP and to the Crypto Elite Mastery course, the links will be available in the description in this post and on the blog at blog.cryptoelite.com. So these 2 pictures, this picture right here, the cycle of market emotions, and then the next one I'm going to show you, they demonstrate market sentiment incredibly well. So the first one is the cycle of market emotions, and the second one is the Wall Street cheat sheet. Basically, what the cycle of market emotions is saying is that as the price goes up, first it goes up a little bit and there's optimism, and then there's some impatience because you really want to go up higher, and then there's excitement because it's really, really high and everything's going great, so then everyone starts jumping in, and then it gets to be overbought and there's too many buyers and everyone is super confident that it's just going to keep on going up and up and up and up and up. Successful traders recognize this as the point of maximum financial risk, and they never buy when there is too much confidence in the markets and the price is at resistance and at the very all-time highs. They usually never buy until there's a confirmation of a break and a retest usually. And then finally, there's the denial, the regret, the fear, the panic, and the despair when the price just goes down, 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 down. And that is the bear market. And like this says, successful traders recognize this as the point of maximum financial opportunity. So the point of maximum financial opportunity for Bitcoin was around $3,200. And this is the point where you should actually buy if you believe in the fundamentals of the crypto or the project or whatever you're actually investing in. If the fundamentals are there, but the price is somehow very low, then that is the best value proposition. That is the best time to buy. For example, housing. Like in 2009, the housing market was in shambles and it was very, very low. Houses were as low as they've been in a very, very long time. However, houses are houses. Land is land. Like people will always need it. The fundamentals have not changed with housing. So if you had enough cash on hand, you could have bought so many houses, and then after, a few years, the prices of the houses would have gone up, or they did, and then you could have sold them for major profit. Same thing for basically all real estate back in 2008, 2009. For Bitcoin is an unstoppable force. Like it is, the fundamentals are so strong. It's absolutely ridiculous. And there's a few other cryptocurrencies, which I believe that as well. And so when the price is so low, that is the best time to buy. I love it when prices go down because that just means that I get them at a discount. And then finally, we have the Wall Street cheat sheet, and that's the psychology of a market cycle. The way that this depicts markets is so accurate, it's almost scary. The way that this really showed what happened in 2017 when there was the huge bubble and then the crash that subsequently followed it. Really, there was hope, optimism, belief, thrill, and then at the peak of $18,000-$19,000 per Bitcoin, there was major euphoria. And I saw it when the price started to cool off and we had the first dead cat bounce, there was a lot of complacency. There was a lot of people saying, oh, we just need to cool off for the next rally, hold on to your coins. I remember HODL was the biggest term in crypto, and it was so dumb because so many people just held on to their life-changing savings, life-changing money. If you have money that can change your life, you need to sell it and literally cash out. And so many people did not do that because of what this chart is saying about the complacency. They say it's just a little pullback, it's just a little consolidation, it's healthy, all of that stuff. But no, it's not. And then of course the anxiety comes in, and then the denial comes in, and then finally the panic comes in, and that's when a lot of people start selling. And then finally there's the capitulation, and people just get out of the markets. They say, man, I can't afford to lose anymore. And that happens after they could have sold for so much, and they just held and held and held and held. And that's the difference between a trader and a gambler. If you're an investor and you want to just simply invest for 10 years and go through these cycles multiple times, that is perfectly okay. Of course, I would rather sell when I see that the market sentiment is in the euphoria stage, because it will most likely, like not even most likely, it will like almost guaranteed come down every single time. And I do have another video which goes into the different market cycles, and it shows you how we actually have been through this exact, hope, optimism, belief, thrill, euphoria, complacency, anxiety, denial, panic, capitulation, anger, depression, disbelief, and then we started a new rally, and we've been through this with Bitcoin at least 3 times so far in Bitcoin's history. So this happens in every single market, and this is something, like I suggest, print it off, have it on your desk, have it somewhere where you can look at, and you should always keep this in mind where we are when determining where you want to invest your money, when you want to invest your money, and all of these other decisions that you will make. Alright guys, we have covered a lot, so let's just do a quick rundown before we go any further. The first thing that we talked about was the basics of what makes a market. Basically, you need to have buyers and you need to have sellers, and you need to have an asset that they're trading back and forth. Basically, it's the same thing like at an auction. When you have the asset, when you have the product, the person who owns the product is the asker, and then there are the buyers who are bidding for the product. Same thing with the market. You have the askers and you have the bidders. The people who want to move the price up are the bulls, and the people who want to move the price down are the bears. And with pretty much any market that has billions of dollars within it, there's going to be whales and institutions that like to manipulate the price. So it's important to understand that if you're going to be trading, you're going to be trading against these giant people and corporations that have a lot more capital than you do. And you need to figure out how you can trade with them and be basically on their backs. And after we discussed the fundamentals of what makes a market, we started going into investing, which is the first thing that you should actually be thinking about when you're getting into money and finance and everything like that. You don't want to jump into trading right away. You want to go into investing, because investing for the long run is what sets you up for your life and will actually set you up for financial freedom if you can do it right. Trading is a means to put more money into your investing account. So investing comes first, trading comes second. And that's a really important narrative that I want to share with you guys, because I think a lot of people just jump into trading and they have no experience with financial markets, especially like how I mentioned in the first video. Most people that get into cryptocurrencies are brand new, but if you can learn to invest properly, that can set you up so well, and you might even end up doing better investing than simply trading. With saying that though, obviously this is about trading or investing and trading, so we went into trading and we went into the different trading styles that you could use. And the question that you have to ask yourself is, what trading and investment styles will be best for you? Do you want to be a swing trader and take the long route? Do you want to take a day trading route or a scalping route and be in front of the computer? It's really up to you. Then after going over the different strategies that you could use when trading and investing, we dove a little bit deeper and went into the different tactics and pretty much how to trade by going over things like fundamental analysis and technical analysis. Now, if you remember, there's 2 types of technical analysis. There's price action TA, and then there is computerized technical analysis. And so we went over the different patterns that you could look for when using price action TA, and we went over a few of the different indicators that you could use when going over computerized technical analysis. Then we went over the order book and the order history, which are 2 other tools that some traders like to use. I don't personally like to use them too often, but we just went over them for the sake of covering everything that we can. And after we went over all of that, we took a step back and we looked and we made sure that in order to use these type of indicators effectively, we need to know where the general market is. We need to have the sentiment of the market and be aware of what it is, and also be aware of the market psychology and where we are in that psychology graph of the market cycles. In the last part of this 3-part series, we're going to be going over things like actual trading strategies that you could use when you are trading cryptocurrencies. We'll also be going over things like risk management, which is vitally important and something that a lot of people don't really talk about because everyone's just going for those giant gains. But if you learn to use risk management properly, that is what's going to set you apart, and that's what's going to let you be consistent over time and have gains day after day or week after week or month after month. And then finally, at the end of the next video, I'm going to be going over a sample trade and show you exactly how I trade step by step by step so you could walk through it with me. And then if you want to join, you could come over to cryptoelite.com and join the CryptoElite crew if that's what you want to do after seeing everything that I lay out for you here. And of course, my camera dies 2 seconds before this video is supposed to end. Anyway, I just want to thank you again for watching this. If you haven't seen part 1 in the series of how to trade and invest into cryptocurrencies and Bitcoin, then watch that. It's really informative, especially on the investment side. And stay tuned for part 3, which is the final part, which I just explained before. And be sure to follow me on social media like Twitter at Louis Raskin. I give out a lot of my own personal trades, and on CryptoElite, where you could contact me pretty much anytime. Other than that, I have a lot more videos in store. Stay tuned if you're into crypto, if you're into Bitcoin, if you're into trading, if you're into investing, if you're into all of this and you really want to figure it out, I have a lot of videos in store for you. Also, if you haven't yet smashed that like button, be sure to do that. Leave a comment if you have any questions or anything that you want to comment. And with saying that, you're awesome, stay awesome, and I'll see you in the next video.